Okay, it's there. All right, let's begin. So let's look at the question here. Not question, the statement here. Plus 500 is an online trading platform that will enable you to open a virtual account and trade with virtual money. So basically, you need to use the plus 500 lah to do your trading. Okay, you can trade as many transaction or volume as you like with the amount of virtual money given. All right, there's a virtual money. Using technical analysis as your trading strategy to make investment decision, choose one contract from any 4 different underlying asset categories: commodity, forex, indexes, ETF, and shares to trade. Make sure the market for the contract that you have selected is not closed. The contract would have one open and closed ongoing position. Justify the reason and the rationality of your transaction and outcome of the transaction using technical analysis. At the end of the class, check your position and share with your friends whether you made a good trading decision. So this is by right supposed to be a practice on how you're going to do this in this class. So by now you're supposed to go and download this app and then start doing some trading. So end of this class, you will try to share with your friends whether you make a good trading decision or not. So this is what you need to do for your assignment. Okay, you need to use this plus 500 to make decision on your tradings. All right, you have different underlying assets category. Okay, in the site in plus 500 itself, choose which you need to choose 4, if I'm not mistaken, out of the given one. You need to trade at least 4 different underlying assets. Okay, and every time you make a decision, it could be supported with market or technical analysis. So in today's activity, you just use technical analysis. That means look at the trend, look at the graph. So what kind of readings you're going to use? Are you going to use the SAR? Are you going to use the Bollinger Band? Are you going to use the Fibonacci? Are you going to use the candlestick soldier? What are the bases to it? Okay, what are the floor and ceiling, the head and shoulder? All these are techniques, technical analysis techniques that you can find online. So choose whichever which is best for you to make yourself go into a transaction. Okay, so in your assignment there, every time you close a transaction, you need to make a screenshot to show that you close it or you did not close it. So it's not necessary you must close it also. So some of you think that I want to continue holding it because you see the prospect, but you screenshot at that moment now of your write up at what point now. So are you making a profit now or not? Or are you making losses now? You're making profit now. How come? Why? Does it reflect on your decision making? If you're making a losses, justify. Maybe this is not the time yet. I'm planning it for the next 3 months. So now it's only 3 weeks. So it's not sufficient to judge. It's a wrong judgment. Okay. So these are the reasonings that you must give. Every decision you make must be a reasoning there. So what I suggest to students is don't make until last minute. Okay. You can do as many trading transactions as you want, but in the end of the day, you only choose those that you want to present in the assignment. All right. So that's why you try the more, the better. Then you can try different technique. You can make sure which one is working. Then you can choose which one you want to write in your assignment. Okay. So most of the time, students will wait this until the last day. 1 day before submission, they only start doing trading. So by then, if I see the trading is all minute trades or short-term second trade, means you never do any studies. You never use any market analysis. You are solely basing on technical analysis because you're doing a last-minute job. So my suggestion is you guys start looking at the app now, start exploring it, start to learn how to use it, and make sure you manage to screenshot those transactions you made that you might want to include in your indexes when you write in your assignment. Okay. So any questions so far? Start downloading the app. You need to use you need to download the app. Okay, and best part now, you need to start practicing using technical analysis to analyze what kind of things you want to buy, what kind of underlying assets should you invest in, why should you make that kind of decision, why today you go into the market, why you don't go to the market today, why you short now, why not buy now, what are the reasons here to encourage you to make such decision. Okay, this is on technical analysis only, on trend studies, on chart studies. But of course, if you're looking at some other commodity like oil, gold, and so on and so forth, it might be influenced by the market. Okay, so that means market analysis. So in the world, someone say something, or OPEC say that there's shortage of oil now, then oil price automatically will go upward. But then you already speculated that to happen, so you buy earlier on during the announcement, And after that, when it goes up, you manage to sell it and then earn a certain profit. So you explain it based on the market studies that I found out on Bloomberg in 2020, dated when, cite it, give the referencing, then okay, done. That's how you do your assignment. All right, so I think I already give you a rough insight on how do you want to start with your assignment. So my suggestion is you guys better start trading now, so you have a set of portfolio to write later on. Okay. All right. So I think so far I haven't have any issues with assignment, or maybe you haven't started reading it yet also. So never mind. As we go on, if you have any questions regarding assignment, please voice it out in the class. Then we can discuss further, or I can further elaborate for you, or see how can I assist you on based on the question space or questions that are given to you on your understanding. If you don't understand, you have clarification to be done, you can come in, talk to me. You can send email to me too. All right. So let's go into the theory section of today's class. So I don't really use much of the whiteboard because it's all theories, yeah. So by just elaborating verbally, hopefully then you can manage to understand better and take notes of those important points. All right. If there's no necessary, I won't use the board. If there is, then I will use the board. So let's look at the second question here. Why does a technical analysis ignore market fundamental? Okay. Why does a TA ignore market fundamental? Why technical analysts ignore market fundamentals? All right. Because very simple. A technical analyst person, they believe in technical analysis, which is on trend studies, and on graph studies and movement of the historical data. Okay. Why they ignore market fundamentals? Because they believe that fundamental factors are already reflected on the price. Okay. That means it's too late. By the time you get the news on the news, by the time you receive a hot announcement via the news or via the media, it's already too late. The price has already adjusted. Okay, the price has already adjusted. The market has already converted because people already make good use of the internal news that they might get in hand earlier on. That's why they believe it's too late. They don't even bother looking at the market fundamentals. They only look at their own chart studies. They believe in that. So number three, they're telling you what is the main focus of fundamental analysis. All right. So fundamental analysis is very simple. What is fundamental analysis? Okay, the focus of a fundamental analysis is basically on the supply and demand of the market. If there is oversupply, naturally the price of commodity will drop. When there's a high demand, naturally the price will go up. So simple as that. This is the fundamental analysis here. All right, it's basically based on supply and demand. All right, so you see now what happened to graphic cards in the world. The price went up. Okay, graphic card price went up. What's the reason behind it? Supply low, semiconductor market under supply, not enough supply. So supply low, but high demand for it. Why? Due to cryptocurrency price fluctuation or price going up. So everyone is looking to do mining now. Okay, so the semiconductor market under supply, but there's over demand for it. That's why you see PlayStation 5. Why? They come out in batches and batches only. Why not in mass production? Because semiconductor shortage. They could not make PS5. Not enough of graphic cards. No supply. No supply there. But there's so many demand for PS5. All right. So this is basically fundamental analysis. Okay. It basically depending on the supply and demand. Okay. So far, any issues? Any problems? No. Okay, good. See, Lim Bun Mi here is trying to find 2 more people to form a group. So those who have no group, you might want to contact him. He or she, I also don't know. And Ring Ng. So these two students, yeah. So you got Dale here, interested. You all can take note yourself. So this one I leave to you all to settle yourself. Okay, so I move on with the discussion. Number 4 here, list 3 reasons why futures market participants are so concerned about analyzing various economic and political factors. Why people who trade futures? Why futures market participants? They are concerned about the economic and political factor. So they want 3 reasons. So number 1 is why. Okay. So why do you need to know about the economic and political? Economic, you know lah, the GDP growth rate, the country economic growth rate, and etc. So many other things there. Okay. So the political here, you want to talk about the political stability here, or political party strength here, and so on and so forth. Okay. So why do you need to know the economic and the political factors as a futures market participant? All right. So very easy. Okay. Very easy. Because economic and political are the 2 major issue or 2 major component that will drive futures price. Okay. It will affect futures price. All right. So if the economy is showing you it's not good, that means the country is not developing too well. So that means the demand for a particular commodity futures will be lesser. So it will affect the futures price. The futures price will be lesser also. Okay, there are different effects from different economic and political factors here. So maybe some political party, they will impose a certain tariff to a certain commodity. That will increase your future price for the commodity already. So this is number 1. Number 2, okay? Number 2, you want to know about other investors' reaction. All right. Why you want to care about other investors' reaction? Because, like I tell you, the futures market are determined by supply and demand. So by knowing, the other investors' reaction, you know whether they are positive to the particular news or not, or are negative to it. Okay, then it will affect the price. If they're positive towards the news, that means they will start buying. When they start buying, the demand goes up, the supply goes down, then the futures price will goes up. But if their reaction is to stop and start selling, that one will drive the market opposite. That means the futures price will drop. So these are the major 2 things that why market participants are so concerned about the economic and political factor. Number 1, it affects the futures price. Number 2, you want to know it affects the other investors' reaction. And finally, with the combination of the information, you can make decision. By having a good understanding of the economic and the political condition, and how you're going to reflect on the commodity, it can assist you on making decision. So these are basically the 3 reasons why they are concerned about economic and political. Number 1, they want to know how it's going to affect the futures price due to the regulations. Number 2, they want to know other investors' reaction. And lastly, they want to make decision whether to go into the market or not. This is the 3 simple reasons why futures market participants are so concerned about analyzing the various economic and political factors. Okay? No rocket science here. It's quite straightforward. All right. So, number 5 here is much more interesting. So, there's more thing to explain here actually. They're telling you here, interest rate are one of the key factors involved in fundamental analysis of financial futures. So indicate the most likely pressure upwards or downwards. That means whether it's a increase of pressure or decrease of pressure on Malaysia's general level of interest rate for the following economic indicators. So these 3 are economic indicators. All right. Number 1, rising inflation. Number 2, falling unemployment. And number 3, increasing in retail sales. Okay, so how are all these things affecting the interest rate? Okay, you want to know how all these things are affecting the interest rates. So look at the first one, rising inflation. What does it mean by rising inflation? What does it mean by rising inflation? The increased changes of prices of goods. That means things are getting expensive. Correct or not? Yes or no? Hmm? Hello? Yes. Okay. All right. So inflation go up means price things are getting expensive. All right. Things getting expensive. So when things getting expensive, what is this indicator towards the economic? Is the economic now better or worse? When things is expensive, what is consider? What happened to the economic here? What does it indicate? Come on, anyone have the answer? No. No one will try. Okay, so look at this. Remember what I tell you today. Rising inflation, basically, in common terms, we understand it as things getting expensive. When things get expensive, when? All right, things get expensive when it shows the economic is growing. That means the country is growing. Okay, when country is growing, all right, then only things could be expensive and people could afford it. Okay, so rising inflation is an indicator of economic growing. Okay, so when economic growing, it means what happened? Economic growing means people want to expand. People want to expand their businesses. Rising inflation. Rising inflation is bad for the economy if the economy is bad. But rising inflation is not bad if the economy is growing. So actually rising inflation, it shows that is supposed to be an indicator of economic growing. Okay, a growing economy. All right. So yes. So a rising inflation is an indicator of a growing economy. A growing economy means businesses wanted to expand. Okay, they already see a potential. So people want to expand their businesses. So when they want to expand business, what do? They borrow money. Okay, they borrow money. Makes sense, right? Business want to grow, business want to be expand, they need money, so they borrow money. So when they borrow money, that means the demand for loan has gone up. So when demand of loan goes up, what happened? I told you the demand supply, right? So demand for loans go up. What happened to your loan? Your loan become sought after. So in that case, interest rates will increase. As people ask for loan, all right, the supply is lesser. More loan are available. So what these financial institution will do? They increase the interest rate. Who can accept the high interest rate? Then they can take the loan. Who cannot accept? Then too bad. You are automatically filter off. So this is an indicator, okay, of interest rate increase. So increase rate, there's a pressure of upward increase on interest rate. So this is the answer. The answer to this question is basically here: interest rate upwards or interest rate increase after so long of explanation. So can you see, the economic indicators make a big difference? So most people see, oh, rising inflation, things get expensive. That means economy gonna be bad now, like that, and so on and so forth. So no, you see that when the economy is bad, what the government try to do? zero inflation. Why? They want to encourage spending. So they encourage spending, then the economy can grow. If there is no spending in the country, then economic is not moving. That means it's stagnant. So why, when it's bad economy, the government will implement zero inflation? Because they want to encourage purchasing. Okay. So if there is a high or increasing in inflation, that means the economic is growing well. When economy is growing well, all businesses looking at the potential, they want to grow their businesses. When they want to grow businesses, this is the time they will borrow money. So when they borrow money, the demand for loan will goes up, and it will causes the supply to be lesser. So loan can be charged at a higher fees. That's why interest rate goes up. Okay, so interest rate is upwards. All right, I hope that you are clear with this explanation. Okay. Any question, please voice it out on the chat. If you never voice it out, I might miss you. So Niall asked a good question just now. I think now he got the answers. All right. So now the next indicator here is falling unemployment. So when you see falling unemployment, it's an indicator of what? Economy growing or declining? Less and less people losing jobs. More and more people are having job. Okay, more and more people having job. So this is an indicator of economy what? Growing or declining? Growing. Okay, growing. Very good. All right. Falling unemployment, that means more people get jobs is because the economy is growing. So you can link this to the previous question again. So when the economy is growing, business are expanding. So they will recruit more people. When they recruit more people, less people are unemployed. Okay. So what is this indicator again? To the interest rate. Interest rates upward. Interest rate goes up. All right. As long as you can see, economy is growing, then your interest rate will definitely go up. All right. The only time that your interest rates go down is when economy is declining. So if you realize, right, because of the COVID, you see our Malaysia, Malaysia Bank, the Bank Negara Malaysia, has been setting a lower and lower interest rate. Okay, this is to encourage or to boost the economy. Okay, to enhance or to help the economy to continue growing instead of further declining. Okay, so it's very obvious that due to the pandemic, the economy has been going downwards. Okay, everything is suspended and etc. So that's why the Bank Negara has imposed a lower interest rate to encourage borrowing to grow the economy of the country. So whenever you see the indicator shows that the economy is growing, okay, a scenario that highlights the economy is growing, then the answer to the interest rate is always upwards. So let's look at the last one. If they tell you increasing or retail sales, okay, what is that indicator? Increasing in retail sales. So that means you go to supermarket, all these shop slots and stuff, they got higher sales. More people are shopping. More people are spending money. So when people are spending money, do the government need to encourage them to spend some more or not? No, they're already spending money, right? So in that words, this shows that the economy is growing also. It's an indicator of growing economy also. Because if economy is bad, people could not afford to buy things. So sales will drop. But because of the economy is growing, then only people can afford to buy. The purchasing power is strong. So that means sales increases. So in this way, economy growing already show is an indicator. Is an indicator of a economy growing. Then you can know the conclusion of the interest rate. As I tell you, when you find out that the economy is growing, your interest rate is always upwards or increasing. Okay, so these are the three different scenarios to indicate what is the the economy position now? Is it growing or declining? So 3 of the statements also indicate a growing economy. All right. When you can see that it's a growing economy, the answer when you talk about interest rate, it will definitely upwards. All right. If any of the scenario shows that the economy is declining, then your interest rate will drop. Interest rate drop to encourage expansion or investment, and that will boost your economy to growth again. Okay. Anyone are lost or confused in any of these 3 scenarios? Come on. Any questions for me or not? Anyone? Nobody? Very good on this class. Oh, easily understand what I'm delivering. All right. Hopefully, in the finals also, you all can be like that, that you understand everything. I'm looking forward for very high achievement from this class. Okay, it's a good thing that you all can understand my delivery. All right. Okay. So please don't be shy. If you got questions, must ask. Okay. Although I say you're good, somehow you might have questions. You can ask me. Don't be shy. So let's look at question number 6. Okay. Question number 6 here. What are the reasons make futures contract an excellent hedging tools? So why futures contract will be an excellent hedging tool? So very simple. Number 1, let's talk about it one by one. Transaction cost. Okay. Transaction cost. The transaction cost of a futures is only a portion or fraction of the underlying assets. Okay, the cost for trading futures are a fraction of trading the underlying assets. So it's only a fraction of an underlying assets. So number 1, people think that this is a good tool because it's a portion of the underlying assets. So number 2, all right, there's margining. Okay, there's margining. So you can have low capital, high investment. This is basically talking about leverage. So of course, when you talk about leverage, there's also high risk. That means your low capital for high investment, small movement, you get high profit. Small movement down, you get high losses also. So margining is the advantages of futures market. Why people think this is a good hedging tool? Because you could leverage on a small capital. Okay. If you use hedging, if it's hedging, leverage is actually good, because with little money, you can protect yourself. But if you are using leverage, not because of hedging, is used for speculation instead, that one is you are putting yourself in very high risk, high default risk. Okay. And lastly, why these futures are excellent tools? Because the futures market allowed for easy unhedging. Okay, allows easy unhedging once a target price reach. This statement is basically related to this only. Futures, you got a lot of choices. Okay, forward cannot, you only customize. But in futures, they got a lot of choices. So once it's reached a certain target of price, okay, then you think, oh shit, I already hedged wrongly now. So you can re-hedge it easily. You unhedge the previous one with a new transaction to unhedge the previous one, and then you can start going into a new transaction easily. Okay, because it's a lot of ranges are available, so it's easily traded. Okay, so 3 things why this is a good excellent this is why this is a good hedging tool. Number 1, because the transaction cost is a fraction of the underlying assets. Number 2, they allow margining, or we call it leverage. So low capital but high investment. Okay, with low capital, you can hedge for a large amount of assets. And lastly, is easily unhedged. Okay, you can easily unhedge. So these are the three main reasons why future contract are good hedging tools. Okay, so now we are at the last question already. Explain and differentiate between long hedge and short hedge. So this is very simple, no? Very easy, right? Long hedge versus short hedge. Okay, so what's the difference? All right, very simple. Who use a long hedge and who use a short hedge? Remember this. All right, a long hedge is usually a person who need something constantly. Okay, so for example, I like to use AirAsia lah. So AirAsia is a flight company. Okay, and you know flying around require fuel, and fuel price is not stable. It's always fluctuating. So for them to have a hedge, they will want to buy petrol at a price they want. So they will hedge it. Okay, they will hedge it. They will long hedge at a price that they want for their petrol. So that's in case if the price goes up, they can still buy it at that particular price. If it goes down, then of course they lose it a bit because they're trying to hedge it. So they will still buy at a slightly higher price. So it's just to reduce the risk that Asia will face if there is an increase of oil price. This is who will use long hedge. Okay, a person will use long hedge only when they need something constantly. They need to consume it. All right. A short hedge, on the other hand, is usually, or primarily used by supplier of commodity. So just now here we say Asia wants cheap oil, so they use long hedge. They lock themselves. All right. So oil supplier, they want to see profit. Of course, they want to see profit now. Okay, they scared oil price drop too low, then they lose money. They cannot earn that much anymore. So what they do is they short hedge. They set a price they want to sell. So for example, now it's $100 per liter. Okay, all right, drop to $100 per liter. The regular price is around 200 to 300 per liter. So if you are a supplier of oil now, okay, you're scared that it will drop to 100 liter. Current price is around 2 to 300. So what you're going to do, you go into a short hedge to sell it in 3 months later. So assuming you scared 3 months later, it become $100 per liter, you lose money. So you short hedge here. That means you want to sell oil, let's say for $200 per liter in 3 months time. Right, current market is 200 to 300, so you still have to get at least the minimum of 200 liter. Again, $200 per liter. So let's say the price drop to 100, they can still sell at $200 per liter. So this is what we mean by short hedging, and it's only used by usually used by supplier of commodity. Okay, they need to lock the prices of selling a certain commodity in the future. So this is the difference between long hedge and short hedge. All right, you will go into long hedge if you need to buy something constantly. Okay, you're scared that the price of your raw materials goes up. You may be a manufacturer, you may be an Asia that needed oil. Whereas when you're short hedging, you're someone producing that raw material. Okay, you are producing of palm oil, you are the producer of petrol oil here. Okay, so you scatter the price drop. That's why you short hedge. You lock it at a price to sell to people. Then you won't make any losses. This is the last question. So, any questions from my students? Any questions from you guys? Can you explain unhedging? So if let's say I already long hedge now to buy to buy cheap oil at let's say now the price is 200 300 lah. I want to make sure that I can buy oil 3 months later at $100 per liter. All right. Then I see 2 months later, before its expiry, the oil price is already $50 $60. So I want to unhedge easy one. So I just short 1 month oil at $100. So whenever I buy 100, I sell back $100. Then I can just buy at the cheaper rate in the market then. So I already unhedged one. Because futures is available, there are a lot of choices. So if I already, so for example, I long oil at $100 per liter for 90 days. Okay, 1 month later, I realize, oh, oil price goes below 100, so I don't want to buy at 100 anymore. I better go and wait further because I think that oil will drop further. So I just short oil at $100 per liter for, you match the day lah. If it's already 1 month past, for the next 60 days. Then both of them will expire at the same time. Okay, this one you long and you short after that, that means you already unhedged. What? You already unhedged. No more transaction going on. Can, Nail? Can you understand? Yeah lah, when you break even, there means no hedging going on. What? When you break even, that means you already cancel off this transaction. So initially you have this to hedge. But when you caught something to cancel this off, then there's nothing going on. What? That means you are unhedged. What? You're following the market right now. Make sense or not? Can, Nail?